Yields jumped globally after the move. You can see Japan's stock market lower. Our dollar tumbling lower. That's what that's showing there. And look at our 10-year note up to almost 3.7%. So why did they surprise markets like this? And why the strong reaction? We have a delight today. CNBC contributor Michelle Caruso-Cabrera here on set with me, along with Peter Bookvar, who's also a CNBC contributor and CIO of Bleakley Financial Group. Welcome to both of you. Perfect duo to help break this down. Michelle, let's start with why did they do this?
So if you think about what's happened with interest rates for the last 10 years, think about it like a mattress. Every single central bank in the world was pressing on their respective spring, right? And then suddenly we started to see all these central banks around the world lifting up on their springs, except for the Bank of Japan. They kept pressing and pressing and pressing. And what they revealed today is that their arms are getting tired. They just can't do it anymore. They're going to start to let their interest rates rise because they have to. Because it was going to get out of control if they didn't do something.
Why was the reason that they tried to keep rates down? Just it would be too expensive, or what was the purpose of this policy?
Remember, they've always been way more aggressive than everybody else because they were fighting deflation. They were trying to get prices to rise for years and years and years. So they did something way more radical than even the United States did. You know, the U.S. says, we want interest rates to be lower. We're going to go out and buy $90 billion worth of treasuries. Bank of Japan said, no, we want our interest rates to be at a certain amount. So we are going to buy as many treasuries as we have to buy.
Wow.
There are days when there are no trades in the Japanese treasury market because they are the entire market. They own 50% of the Japanese government bond market. That's how radically interventionist they are.
Peter, we know it's a huge market, so itself, whatever they do has implications. But also, when you hear what Michelle's describing, you go, well, you can see why people might think this is a preview of what's to come elsewhere. Why did they stick with this policy even when it seemed like everyone else was starting to back off?
Well, they almost became an arm of the government in terms of fiscal and monetary sort of meshing together, that the fiscal side still had to spend a lot of money. They have extraordinary levels of debt. And the BOJ was sort of meant to keep their financing costs so low. But the position became untenable. On Thursday, they're about to print headline inflation near 4%.
Wow, in Japan.
And ex-food and energy, 2.8%. And to continue with the straight face, keeping policy as is, just became, I think, as I said, untenable. And maybe Kuroda just wanted to do something before he leaves at the end of March.
The governor. But here's what I don't understand. If their goal was to get inflation higher, and then they achieved that, so is this did they achieve what they wanted, or was this not working? It seems like the very goal is now the problem with this policy.
Well, the problem with keeping the yield curve so suppressed is that it destroyed the Japanese banking system. The Japanese Topix Bank Stock Index is down 88% in nominal terms from where it was in 1989. How can you have a healthy economy if you destroy your banking system, since so much monetary policy and lending is supposed to flow through the banks? So rather than generating faster economic growth, it actually depressed economic growth in Japan.
Yeah, and why they stuck with it, you know, mystery, right? They finally achieved what they wanted to achieve, and yet they're so enmeshed in this policy. One of the implications of what they did for decades is that Japanese investors, because they could get no yield in their home market, tended to be big overseas buyers of other stuff. The average Japanese investor was far more likely to buy, say, a Brazilian high-yield bond than your average American investor would be. And that's why you saw yields all over the world go up. Because if the Japanese at home can now start to, and they're not getting there yet, but they're starting to get more yield at home, then they will buy fewer things overseas. So you have a big buyer that is potentially leaving the market.
And what's the implication, Peter, beyond, as Michelle said, that immediate impact in some of the places the Japanese might invest? Like over the next 6 to 12 months, what's the broader message you think for global monetary policy or for U.S. investors? I mean, what are some of the takeaways?
Well, when you look at the last 10 years, where's a lot of the excess? And it really was in European bonds with negative interest rates and also in Japan. So you have this sort of bubble deflating in these bond markets that, as Michelle said, is going to have global implications. So the BOJ is going from 25 to 50. What happens if next year they go from 50 to 75? It's going to keep interest rates around the world elevated for longer. And also, to your point, the Japanese used to own $1.3 trillion of U.S. Treasuries going into this year. That pile has now been reduced by about $250 billion.
Wow.
And it's likely going to shrink. And foreign central banks have been a net seller of U.S. Treasuries this year, which will go as part of the story with the BOJ, likely continued sellers as we go into 2023.
So you have them selling, you have the Fed, not buying more, maybe selling. In other words, like a lot
banks
of these
selling less too.
Banks, so all of a sudden,
and a lot of supply coming.
Exactly, the size of the Treasury auctions has increased. Rick has talked about how some of the results have been worse lately. So do you think that's what gets us a 10-year at 3.7%? Is that too high, or is it normalizing? That is the key rate for our entire financial system.
I think you can make the argument, if you were just analyzing U.S. growth and inflation stats, you can make the argument, growth is slowing, inflation's moderating, the 10-year should go to 3. But for the reasons we just said, I can make the argument that the 10-year goes to 4.5 to 5. And if it did that, it wouldn't be for good reason. It would be because these governments and these central banks further lose control of their bond markets like the Bank of England did.